Okay, and I hope the mic is on and camera is on. Okay, good morning, everyone, and welcome to the Lee Kuan Yew School of Public Policy. My name is Danny Kuan. I'm Dean and Lee Ka-shing Professor in Economics here at the school. It's my great pleasure to welcome all of you this morning and to introduce the public lecture that we're going to have on global economic prospects. We are fortunate and delighted this morning to have IMF's Chief Economist, Economic Counselor, and Director of the Research Department, Pierre-Olivier Gourinchas, with us to deliver this lecture. Pierre-Olivier will over the update to IMF's World Economic Outlook, titled intriguingly, Inflation Peaking Amid Low Growth. Now, some of that update and discussion you will have already seen in the world press. Yesterday morning, this update was unveiled worldwide here in Singapore. And those of you who follow these things will know that there's been a wave of attention. The Guardian newspaper, the New York Times, Bloomberg, everyone has picked up on the message that we're going to hear this morning and that we're going to get to unpack more of, because Pierre-Olivier has agreed also to have a conversation with all of us, including our friends who have come in online today. In the eyes of many of us, it is the IMF that holds stewardship on the global economy. It is the IMF that provides us the research to give us the most reliable, most credible, best account of what is going on in the collection of economies around the world. It's the IMF whose judgment we draw on to flash warning signs on impending risks coming up for us, to help draw for us the most critical of economic and financial challenges that the global economy faces. We are delighted this morning to be part of that global conversation, to actually be leading that global conversation as continuing discussion of this update ripples around the world. Pierre-Olivier has said that he will speak for 15 minutes, after which we will transition into a group-wide conversation. Those who are viewing this online, as usual, are able to type into the relevant chat box their questions, and we will pick up the discussion as we go along. This morning's session will go on until about 10:45, or about 80 minutes or so from now. Please join me in welcoming IMF's Chief Economist, Pierre-Olivier, to kick off our conversation with his presentation this morning on the update to the World Economic Outlook. Pierre-Olivier. Yeah. Yeah.
Okay, I hope you can hear me now. So again, let me say how thankful I am for the opportunity to speak to you today. And I thought I would, in my 15 minutes, called Global Economic Prospects, but I thought I would try not to repeat what I said yesterday when I presented the World Economic Outlook update. We did a launch here in Singapore. And got a lot of very positive feedback. But I thought it would be more interesting, especially in front of an audience that is maybe with students and academics and people from think tanks, to engage a little bit more on the substance. So I will talk for maybe 4 or 5 minutes about the outlook and where I think we are. But then I want to use the remaining 10 minutes to talk about some of the research streams we're working on at the fund, in the research department and elsewhere also in the fund, on issues that are first order issues for the global economy. and particularly relevant, I think, for Asia and countries like Singapore. And I will talk about three such research streams. I will talk about geo-economic fragmentation, which is something that has been very much on everyone's mind in the past year, but started before that. I will talk about the work we're doing on capital flow management and foreign exchange interventions, how we can think about an integrated toolkit for macroeconomic stabilization in open economies. So think of this as sort of Mundell Fleming 2.0, if you want. And then I will talk also about some of the work we're doing on the climate transition, which of course is affecting all of us, including here. So that's what I plan to do. So let me start with just, as I said, a quick recap, and I'll give you a slightly different angle maybe from what I presented yesterday on the global economy. And so the outlook here, the sort of the one line takeaway is that in our baseline scenario, and I want to emphasize this is baseline, there are a number of risks, and it's always a delicate exercise to be forecasting. It's even more of a delicate exercise to be anticipating when we reach turning points. But we are basically arguing that we could be reaching one such turning points this year in 2023, that the global economy could be bottoming out with growth that is still slow in 2023. We're projecting about 2.9% for the year, but then expected to start growing, especially in advanced economies. Most of the advanced economies are going to have this bottoming out feature, but not just advanced economies. And then inflation decreasing. So if you think about the point where we're at, that would be a point at which we start seeing more growth and we start seeing inflation moderating. And of course, inflation has been one of the key stories of the past year. And that's what you see on these two figures on the left of the slide. The left one is showing you the projected path for output, for growth projections for advanced and emerging market economies in the world. The world is in black, and the dashed lines are October projections. So you see also that we've had a slight upward revision in terms of this path compared to October. And in October, we were quite gloomy, and we are slightly less gloomy now. And so what's behind this is a story of resilience in many parts of the world, resilience to the inflation and cost of living crisis. Households have turned out to be more resistant and be able to maintain their spending. Businesses have been maintaining levels of investment, in part because they had accumulated buffers and excess savings from support they received throughout the pandemic period, and that is helping them now. Resilience, when you look at labor markets in many parts of the world, unemployment rates are at historical lows, whether you look at the US, you look at European countries, you look at the UK, but also in many emerging market economies. And resilience, when you look at the ability with which many European countries have been able to handle what is a pretty dramatic energy crisis with the interruption of Russian gas flows that was representing about 30% of the gas supplies to the region. And compared to expectations that maybe were formulated earlier in the year when there was the prospect of such a suspension of gas flows, there was a worry that this might really do a lot of damage to industrial output in many European economies and also affect households in terms of energy prices and ability to heat themselves and to power their house and et cetera. And there's been a lot of resilience there as well, in part with the help of government support that was quite generous. On the inflation front, what we see there is that inflation has peaked, headline inflation has peaked, and is already on its way down compared to where it was. And the peak was around the third quarter of last year. That's headline inflation. Core inflation is not, the picture is not as rosy. In many countries, it has not peaked, and it remains very elevated compared to central bank targets. Now, on the right here, there's a list of some of the risks that we're seeing around this sort of baseline. There are a number of risks, but they're also a little bit more balanced than they were before. Before we're sort of looking at the world and we're thinking, well, things can only become worse from where they are. Now we're thinking, okay, well, yes, there are a number of ways things can get worse, but there are also a number of ways in which we could be surprised on the upside. In particular, the speed at which we've seen this disinflation happening without necessarily a lot of deterioration in labor markets. It's suggestive that we might be on a somewhat steep part of the supply curve, if you want, and we could, if that is sustained, we could see faster disinflation without necessarily having a huge increase in unemployment rates around the world. Policies, we're emphasizing that the fight against inflation is not yet over yet. Yes, headline inflation is coming down, but with core inflation that is in 5-6% in many countries, very, very far from the 2% target. And the tightening that we've seen around the world that is quite significant in nominal terms, but in real terms is much less drastic because we have this surge in inflation and that's feeding into year ahead expected inflation. There is a need to remain on the conservative and tightening mode for monetary policy. Briefly on the forces that are shaping the outlook, I've already mentioned some. In addition to the resilience, of course, very relevant for the region, the other big news here since October is the reopening of the Chinese economy. And the reopening of the Chinese economy, of course, has been very sudden, very rapid. A lot of people were anticipating that at some point the Chinese authorities would not be able to maintain a zero COVID policy, which has historically served China well in terms of protecting people, but was becoming increasingly difficult to maintain in a globally integrated world and preventing the economy from reopening. So at some point there was a need for a transition. I think it's fair to say that the transition happened faster than one was anticipated in a slightly less controlled way, if you want. That creates instability in the short term, but it also opens the way for a fairly rapid rebound in economic activity and mobility as the current wave of COVID-19 sort of abates. And the signs that we're getting from mobility indicators, high frequency indicators, or if you look at yesterday's high frequency indices that came out from China, suggest that this is actually what we are seeing. So this this reopening is going to be powering the global economy. As a number that I mentioned in my press conference yesterday is that growth in 2023 is really an emerging and especially Asian story. I mean, China and India together account for 50% of global growth, the 2.9% that I mentioned earlier. But we have still this synchronized tightening of monetary policy that is responding to the inflation pressure, and that is going to put a lid on how much growth we can have this year and into next year. It takes time for monetary policy to work its way into activity first and into prices. It happens faster when it's synchronized like it has been in the last year. And the reason for this is that when all central banks or almost all central banks are tightening at the same time, it affects commodities markets immediately. Global demand being down means energy prices are actually lower. We see that commodity prices are lower than they were a year ago. And that feeds into headline inflation. That is behind the part of the figure I showed you on the previous slide. The sharp decline in headline inflation is in part driven by that. But how it feeds beyond energy into core inflation, et cetera, is going to take longer. And we're seeing divergences in confidence. There is quite a bit of divergence in levels of confidence. That's what you see on the right there. Sentiment in the US and in the world in general is actually remains quite strong, but it's much weaker in Europe. So Europe has been quite resilient, but we're expecting a fairly sharp slowdown in growth in 2022. Okay, so this is for the outlook, and very happy to come back during the Q&A if you want to talk some more about this and some of the drivers. Let me now talk about the three issues I wanted to mention. So first, geo-economic fragmentation. And Danny, I'm not really very good at keeping track of time, so scream at me when you want me to stop. And so here on geo-economic fragmentation, this is obviously a topic that has been very relevant since the Russian invasion of Ukraine, and we've seen that it has split countries along geopolitical lines. And it has, it has deepened existing cracks in the global economic order. It's not that there was no geo-economic fragmentation before. I mean, we've had tensions, trade tensions, for instance, between the US and China. What I'm showing you here on the left is some indicators that this is a rising issue. So what you're seeing on the left is mentions of national security as a relevant reason in one of our publications, which is called the IMF area ER. So it's like the annual report on exchange rate arrangements. And you see the rise in mentions of national security, which of course is often used as a justification for imposing some kind of either trade or financial restriction. And the green line is showing that net of Ukraine. So just to show you that it's not just a Russian invasion story. There is something deeper that is afoot here. And on the right-hand side, I'm showing you also that the mentions of issues like reshoring, onshoring, nearshoring, which are byproducts of this geo-economic fragmentation, are rising when we're looking at earning calls. And you see that, again, started before 2022, but sharply up since 2022. So it's clearly a consideration that has been very important. We're doing a lot of work because, of course, at the IMF, as a multilateral organization that is predicated upon trying to find, and setting up fora where we can find agreements and we can find arrangements where we have rules of law, and when it comes to, rules-based arrangements when it comes to international trade or other areas, having this sort of dislocation and potential reorganization around geopolitical lines, this is seen as a very important threat. And so we're doing a lot of work trying to understand this. I'm going to show you some of the results from that research in a minute. And the first step here is to try to understand the channels. And so obviously there is a trade channel. If you're going to have geo-economic fragmentation, some countries are not going to be trading with each other. There are going to be trade barriers, or there's going to be some sanctions and something like that. That's going to get in the way of efficient allocation of resources. There's going to be some cost associated with that. There's going to be a technology diffusion channel as well. And we see that very clearly. For instance, if you think about the nature of some of the sanctions that are being imposed, they have a very strong technology diffusion component. They are designed to try to prevent technology from getting from point A to point B. And that in turn can slow down the process by which we have technological innovation and therefore potentially productivity growth in different parts of the world. But beyond trade and technology diffusion, there are a number of additional channels where geo-economic fragmentation can matter. You can think about migration, for instance. So there could be rising barriers to migration that reduce efficiency, hinder innovation or technological diffusion, can worsen adverse demographic trends. Some countries are aging rapidly, some countries are growing rapidly demographically. And that could raise also international tensions, because nothing is really as likely as inflamed passions as migration, uncontrolled migration flows sometimes. So migration is one of the dimensions that could also lead to some advances coming from geo-economic fragmentation. There is a capital flow dimension to that. The sanctions are not just sanctions, or the segmentation is not necessarily only along trade lines, but you also have a capital flow dimension. If you reduce the ability to trade financial assets, then of course you're reducing risk sharing. You're reducing also everything that comes with financial flows. If you think about direct investment, that has implications for technology investment and productivity as well. One dimension that is also relevant is that geo-economic fragmentation increases uncertainty. I mean, these earning calls that you see there, where people are worried about nearshoring, reshoring, et cetera, these are businessmen trying to figure out what they should be doing. And in an environment that becomes more uncertain, and you think about the whole literature on policy uncertainty, we know that this depresses investment. This leads to more volatility, and this leads also to misallocation of resources, and it also increases the chance of policy mistakes. Policy mistakes are especially important when you think about fragmentation, because you may have perfectly legitimate decisions that are taken by one country in isolation, but failing to take into account how they will lead to some retaliation and the tit for tat and amplification. And then we get on a road that is uncontrolled and runaway fragmentation. That's certainly a worry we have. And finally, you can think that geo-economic fragmentation can get in the way also of our collective ability to deal with common goods. There are some things that, and I'll come back to that later, but there are some things that we have to address collectively. Climate is the obvious example, but you can think about debt distress for many low-income countries. You can think about the need, for instance, to come with common set of rules for digital assets, which are trans-border by almost nature. And so you can think of a number, or pandemic preparedness. Future pandemics might happen and we need to collectively address them. These are common goods. In a world that is becoming more geopolitically fragmented, there is maybe less scope for reaching agreements across parties that are divided. And that would leave us in a worse place. Now, what I want to show you here is the result of some of the calibration that we've been doing. Of course, then, you want to put this and you want to write down models and you want to sort of crank those models and come up with numbers. It's still, there are a number of dimensions I've just highlighted. So you can't have a model that has all these features together. So you zoom in on one set of features and you try to get some estimates, and then another research line will zoom in on a separate set of channels, and then we'll try to get estimates. And that work is ongoing, both in academia and at the fund. I'm showing you here on the left, for instance, quantitative analysis that looks at the impact of fragmentation through a technological decoupling. So here we do something very, very crude. We split the world into two blocks based on how countries voted in March of last year on whether to condemn Russia for its aggression against Ukraine. So you might say this is very artificial, this is very crude. Yes, it is, but one has to start somewhere. So we put countries into two blocks, and then we ask, okay, what would happen if we have energy and high-tech sanctions between these two blocks so that they cannot trade these energy or they cannot trade high-tech goods? And these are the green bars. So for the world as a whole, what you see there is that already leads to losses that are a little bit above 1% of global GDP. On the right, I'm showing you the losses if we zoom in on Asia. And the losses are actually larger for Asia. They're about 1.5. Then in red, we say, okay, well, what if on top of energy and high tech, we also put sort of Cold War level type of sanctions so that you don't have trade in other sectors either. And here you see that the losses for the world as a whole increase a little bit, but they are particularly large for Asia because a lot of Asia trade is not necessarily energy dependent. And for many countries in Asia, it's not necessarily high-tech dependent. And so they would be particularly hit by that layer. On the right, what you can see is that countries are going to be hit more the more open they are. That maybe doesn't strike us as too surprising, but still we quantify a little bit the extent to which openness translates into losses from this maybe admittedly extreme form of segmentation. We have a number of, as I mentioned, a number of additional research papers that focus on different aspects of this. We have put out about 2 weeks ago a staff discussion note on geo-economic fragmentation. It's sort of an umbrella piece that looks at these different channels and summarizes results. And I'm showing you a figure from that staff discussion note where you have estimates here, and of course, the estimates depend on the assumptions you're making. One critical assumption, for instance, is the elasticity of substitution between different types of inputs, because when you're putting restrictions, and then if you think about an input-output structure, then the key question is, can you substitute away from the inputs that you cannot get access to? And so very critically, elasticities of substitution, openness, and things like that are going to matter. So here you have estimates that are the ones I showed you based on this sort of technological fragmentation. We have other estimates here that are looking more carefully at what happens in the energy sector and modeling the energy sector in much more granular and with an input-output structure that is very common in this literature, and quantifying the general equilibrium effect. And you see here that the cost can increase significantly here global costs. And then on the right, you see a range of estimated losses, again, depending on different assumptions at the country level. So there's losses at the level of the world, but then there is a lot of heterogeneity, and some countries could be hit more than others. And we can find losses in terms of output, in terms of country output of up to 12% of their GDP from these kinds of fragmentation scenarios. So this is something where more work is obviously needed, but this is something where the orders of magnitude are a bit scary. You think that, you know, things could escalate pretty quickly there, and we want to be careful about how we go about this. The policy challenge from our perspective is, well, what message do we want? How do we, at the same time, try to satisfy maybe national security objectives and try to avoid unraveling the gains from having an integrated global trade matrix that has generated tremendous productivity gains globally over the last 4 or 5 decades. And we did some work last year in our April World Economic Outlook, where we looked at the potential for diversification. There's a lot of talk of reshoring, nearshoring, friendshoring. And what we argue is, well, a lot of that is wrong. Why is it wrong? Well, because to start with, oops, my apologies. A lot of that is wrong. Why? Because if you start with, in general, countries are very concentrated in their own production already. There's a lot of home bias in the production of intermediate inputs. I mean, for all the talk about global supply chain, it's still the case that a lot of things are produced domestically. In the Western Hemisphere, it's upwards of 80%. In Asia, it's a little bit less than 80%, but you see there, it's much higher than their domestic share of production, if you want. And reshoring, nearshoring, friendshoring would increase how much of these inputs are produced domestically. So that would lead to a more concentration of risks. The problem we faced during the pandemic and during, you know, a lot of the shocks that we've experienced is the concentration of risk. There's one factory in the world that is producing input A, and if that factory is down for whatever reason and no one gets input A, and that's a problem for all the supply chains where input A is critical, the answer is not to replicate the manufacturing of input A in your own country. That could be very inefficient. The answer is to produce in a number of suppliers around the world, to have diversification of supply chains as opposed to concentration of supply chains. And we did a little exercise here, you can see that on the right, where we said, okay, well, suppose that we have a shock that represents about something like a contraction of labor supply of 25% in a major global supplier of intermediate goods. So think of this as something that would be a proxy for a pandemic hitting a key supplier of intermediate goods with lockdowns that reduce the supply of that input. And if you do that and you feed it through the estimates, you see that this has a large impact on both the world, but also all regions in the world, because this is a critical manufacturer of inputs and it feeds into a lot of the world. And so you have, for instance, in Western Hemisphere or Asia, excluding China, for instance, 0.7% decline in output. If instead now we say, suppose we redo the exercise, but now we've diversified the supply chain, so it's not concentrated in that key manufacturer of intermediate goods, then you see you can more than half the global cost. Not too surprising, diversification helps. So the message here is very clear. Diversification is the way to go. Concentration of risk for national security reasons or otherwise can have very high economic costs. Okay, so let me get to the second and third issue, and I'm sure I'm running low on time. So, again, I'm happy to skip. Here on this slide, I'm showing you the movements of the dollar exchange rate against a number of countries in 2022. So this is starting in February 1st of 2022, so before the Russian invasion of Ukraine. And I split it between February and October 31st. That's in green. And then in red is since November 1st until January 17, so a couple of weeks ago. And of course, the story here, the green bars here, this is the story that everyone has in mind, is the strengthening of the dollar throughout 2022 against most currencies. I mean, the exception are maybe Mexico, Brazil, and Peru here, where you had a very sharp tightening of monetary policy in these countries, so they were able to buck the trend and remain attractive for foreign capital. But otherwise, most countries, and the Asian economies are here on the left, most Asian economies and advanced economies and emerging economies have seen a sharp depreciation of their currency against the dollar. That reversed after November 1st when the market started to anticipate that maybe the news on the inflation front might be a little bit easier in the US, and therefore there would be less tightening in the US, and therefore started pricing less hikes by the Federal Reserve. And as a result, you see the depreciation of the dollar since November 1st. But overall, the black dots tell you still it remains an appreciation over the year. Now, of course, this is a critical issue for many emerging countries. The value of their currency against the dollar is something that they pay very, very close attention to for reasons of trade and competitiveness, for reasons of financial exposure to dollar borrowing, the tightening of financial conditions. There's a global financial cycle that's associated with dollar movements. And so obviously, this is something that is on the mind of many policymakers. What should be done when faced with this kind of movements in currencies and the capital flow movements that are underlying them? Now, this is something that we've been spending a lot of time thinking about at the fund, and we have something that is called the Integrated Policy Framework. This is this IPF here, which is integrated policy framework. That sounds like a very jargony term. Think of it as Mundell-Fleming 2.0. The Mundell-Fleming answer to this would be to say, well, to a first approximation, countries are better off by letting their currency float. So yes, there is a tightening of monetary policy by the Federal Reserve. Well, tough luck. We're in an environment in which financial and monetary conditions are becoming more adverse. The best thing you can do is make sure you let your currency depreciate, because that's going to buffer some of the shock on your local economy. It's going to offset through expenditure switching. It's going to provide you some breathing room. Your exports are going to be able to do better. And therefore, that's the best policy action, is to follow your domestic objectives, not pay attention to what's happening on the currency market. And I'm simplifying a little bit, but that's sort of the typical view. The IPF takes that simplified view of the world, but then it's going to put in a number of frictions that are relevant for the world we live in. Frictions that have to do with invoicing of trade. We know there is a lot of dollar invoicing. That means that movements in the dollar transmit into inflation, transmit into exports and imports in different ways. There's a lot of dollar borrowing. So whenever the dollar moves, it means that countries can be or private borrowers can be up against borrowing limits. They can be facing high levels of debt. It can put a lot of pressure on the financial conditions. So we have a number of frictions, if you want. And so we put this. There's been a lot of work that started a few years back by my predecessor, Gita Gopinath, in the research department, and others, Tobias Adrian in the money and capital market department, trying to put these frictions into the model. And what comes out of this? Well, what comes out of this is that, well, if you're a country with deep foreign exchange market, meaning that you can have large movements in and out in terms of capital flows, but they don't have necessarily a big price impact, we're going to be effectively in a Mundell-Fleming world. And in that world, you could sort of let the currency live its life, and it's going to provide a certain amount of buffering. We're going to have the predictions of the Mundell-Fleming model. And exchange rate flexibility is going to be optimal. But that's not the right framework for a lot of countries. A lot of countries have actually much shallower currency markets where movements in and out by a few large hedge funds or something like that can generate a lot of movements in the price, can be a lot of movement in the risk premium. And so if you have these shallower FX markets, and if you have the kind of frictions I was talking about earlier, then we're going to have departures from Mundell-Fleming. And we're going to have scope for additional instruments to be used, whether that's FX interventions, foreign exchange intervention, or capital controls, for instance, that might come in. Now, this is not a free-for-all. We're just hold on. We're not saying, please go ahead and use all kinds of FX intervention and capital controls because you claim that you have shallow FX market. No. This is still very disciplined, but there will be a case that can be made for using these additional instruments as part of the toolkit. And integrated policy framework means precisely when and how should they be used in complement with typical monetary instruments. And we identified 3 cases where this is relevant. One is what I call the UIP shock world, uncovered interest parity shock. So this is a world in which you have this shallow FX market, and you may have non-fundamental risk premium shock, if you want. Markets may become bearish on your country, or they may become bullish on your country. And then all of a sudden you get capital flows coming in or out, and you get this big deviation in uncovered interest parity space. And if you have shallow FX markets, that's going to be an environment where if you let them happen, this movements in currency and their flexible exchange rate will start having an effect on the real economy that could be undesirable. They will generate volatility that maybe you want to root out. A second case is when you have what I call the original sin world, where you have countries that have a lot of FX mismatch, currency mismatch on their balance sheet, whether at the sovereign level or it could be at the corporate level and household level. And what that means is that if you have a sharp exchange rate movement, all of a sudden it can create balance sheet effects that are going to ripple through the economy of repercussions that are undesirable. And that's also going to be a case where maybe you want to use additional instruments and not just let your currency just float around uncontrolled. And a third case, which is relevant here, is in a situation where you have countries that are where their inflation process is very much driven by where the exchange rate is going, which can happen if you're a small open economy with a lot of imported goods. And you have unanchored expectations. So sharp movements in the exchange rate could be very destabilizing to your inflation dynamics in a way that monetary policy cannot get a control on, because maybe you don't have a very stable, very solid monetary policy framework to work with. And that's another case where possibly you might want to use these additional instruments. Now, there is a caveat there, which is what I already said, that this is not substitute for sound macroeconomic policy. This is in supplement in some cases. Now, I had two little graphs that I wanted to show you, but it would take me too long, so I'm going to skip them. But they are sort of illustrating how we can implement this kind of framework and think about it in a way that is not much more complex than the original Mundell-Fleming apparatus, which everyone is quite familiar with. So let me now, final topic, let me mention very briefly climate. So climate, of course, is something that, you might say, well, climate, well, how is that related to what the International Monetary Fund is doing? Well, very simply, because climate is a macro critical risk, and we're looking at the risks that countries are facing, balance of payment risk and crisis, and obviously climate is there. So we're doing a lot of work to try to understand how we can get on the climate transition that will be smooth and that will sort of get us there and not create a lot of dislocation. And we are far from there. So here, this is sort of the sobering slide that sort of illustrates where we are and where we need to be. On the left, you see the CO2 emissions. This black here is business as usual. This is 2022. You sort of has been on an upward trend. If it keeps going, well, it's certainly not the right path. This in red here is the path that we want to be on. Of course, everyone is trying to be at carbon neutral in 2050, but you're not going to be carbon neutral in 2050 if you're on that path until 2049. That's just not going to happen. So the only way you can be carbon neutral in 2050 if you do the backward induction is if you start already today. And so if you start already today, you want to be at something where you reduce emissions by around 25% or something like that by 2030, which is in 8 years. That's this red path. So you see there's a huge gap between where we are and where we need to be. There is a CO2 price that is required here to get there. If you want to know, at the fund, we are certainly advocating the use of carbon pricing in one form or another. As economists, we all understand the benefits of carbon pricing as it sort of works on the right margins and as sort of a Pigouvian component to it that is helping to internalize externalities. It's difficult and complicated for political economy reason to make progress when we talk about carbon prices. And it's not the only way we can make progress on climate transition. But as a modeling device, it's helpful to think about what is needed if we think in carbon pricing terms. And you can always map other types of policies into their carbon price equivalent and then do the comparison. So here, what I'm showing you, I don't know what that is, but I'm going to ignore it. What I'm showing you is the required CO2 price and coverage have a long way to go. And this is both in terms of the coverage, meaning which activities are covered by carbon price effectively or equivalent carbon price, and what is the average price that is already in the different regions. And we are, as you can see, we're about here. Now, at the fund, we're advocating that there should be a carbon pricing that is differentiated across different regions because there are different responsibilities in terms of past carbon emissions, for instance, or in terms of degrees of income and wealth that make a very sound argument for having a stronger adjustment being borne by advanced economies as opposed to emerging markets. And so that would be sort of the carbon price needed for advanced economies. There would still be a need for carbon price increase in EMs. And the coverage, of course, would have to sort of increase to be pretty much comprehensive by 2030. Again, we're very, very far. The solid line is where we are. Now, this is a problem because when you think about the climate transition, there is a need for a gradual but credible implementation of the climate transition. And the reason I'm saying this is if you have a transition that is not credible, so if you have announcements, but no one knows if that's going to be still there tomorrow or the day after tomorrow, then it's going to create this kind of policy uncertainty I was describing earlier in the context of geo-economic fragmentation. What is this policy uncertainty going to do? It's going to depress investment in energy. It's going to depress investment in green energy, and it's going to depress investment in brown energy. Why? Well, because you don't know what regulatory standards are going to apply to you, whether you're thinking about green investment or whether you're thinking about brown investment. The result is underinvestment in energy. The result is more volatility of energy price. The result is more volatility overall. Now, more volatility in energy prices, that also means more fluctuations in your inflation rate, in headline inflation. So that's going to complicate the trade-off that other policymakers are facing. And what we emphasize, we have a whole chapter in our World Economic Outlook in October that looks at the short-term trade-off that policymakers would be facing if we implement the climate transition. Climate transition is going to increase the cost of energy. That's going to feed into higher prices, a little bit of a supply shock, if you want, but a very low-grade supply shock, but it's going to increase input cost, and it's going to slow down modestly activity. And the question is, how much? And our answer when we do the careful analysis is that if we do it in a gradual and credible way, the impact is very, very modest of that climate transition on either output or inflation. The cost is not zero, but it's very modest compared in particular to the cost of not dealing with the climate crisis. But if you wait, or if the process is uncertain or it's delayed, then those costs are becoming much, much larger. Those macroeconomic costs of the transition are becoming much, much larger. Why is that? Well, because they generate this kind of volatility, they generate this very sharp path for carbon prices further, because if you don't do it today, then you will need to do more tomorrow. And they, in turn, require responses by central banks to try to keep price stability and to try to offset some of the price implications coming in. So there is a clear message here as well, which is we are hurting ourselves if we're delaying. We're hurting ourselves not just in the climate transition. Even if we're holding our objectives constant, this is assuming we get to the same place by 2030, but we're hurting ourselves on the macroeconomic side. Okay, so apologies, I tried to cover a lot of ground in a short amount of time, but I promise you this is over. So thank you.
Thank you. Thank you, Pierre-Olivier. I didn't get any sense that you were taking more time than you should. So much of what you presented is so exciting and refreshing. I think like so many other people, I religiously read the WEO. I read your blog items that explain this. But one of the things that came out so clearly this morning was how much more depth and breadth the work at IMF has been these last few years, that you're looking ahead, that the staff reports are themselves exciting. They feed into this conversation. It is a full-on press on trying to deal with the world's critical challenges, and very impressive. Many congratulations to you and your teams. I thought that to kick off the conversation, I might press you a bit on some of the things that you've raised, and then I'd like to try and bring everybody else in as well. For many of us in Asia, and likely for many around the rest of the world, the consequentiality of good performance in the Chinese economy cannot be overemphasized. It is where many of us export to, it is the nation, the economy from which cheaper imports on the margin keep inflation in check for us. Hugely important. And as in your description for what's going to happen to the global economy, one of the large factors that's causing a bit more of an upbeat tone relative to October is this change in China's economy through its opening up from its lifting of COVID restrictions. Now, the rest of the world can look forward to a bit of a lift from China's growth and India's growth. First, in an arithmetic sense, from simply adding to the growth numbers, but also in a spillover sense. My question is, perhaps to get you to expand a little bit on the risk factors in China's growth specifically. Because while the rest of us look at China's performance and say, this is giving us a boost, China cannot look at China's growth and say, this is giving us a boost. China has got to deal with its risk factors and its challenges on its own. And you'd referred to, the uncertainty still surrounding the COVID policies. But your report, as well as so many of the IMF's discussion papers and staff reports, also make reference to the real estate asset pricing situation. There's also the worry about China's own green transition, because if they are going to be on course on their two carbons policy, max carbon by 2030, net zero by 2060, huge disruption in a large economy, chunks of which have the complexion still of a developing economy that remains energy carbon intensive. So I'd like to hear a little bit about your unpacking of the risk factors there. And then towards the end, I'm going to come back and talk about the geo-economics and China, but just to hear your views on China.
Well, so I will leave the geo-economics for your follow-up. Let me start with sort of the near-term and the medium-term issues. So very clearly, the near-term issues in the context of China is related to the health situation and the public health response to the decision to reopen the economy. It looks like it could lead to a very rapid reopening. There are indications of this. In anything that has to do with public health and the pandemic, we have to be careful. So obviously, that's one risk that the Chinese economy is facing. If there is an adverse development on that front, whether it's a reoccurrence of large-scale infections, new variants, or things like that, regardless of the policy decisions, there would probably be self-motivated decisions by individuals that would lead to an impact on activity anyway. So we have to be carefully monitoring what's happening there and hope that the current wave is, which looks like it's cresting, or it's already crested, will continue to decline. That is sort of very near term, where we're going to have an answer to this in a matter of a month, and I think we are expecting the economy to rebound. The impact on the global economy, there are along two dimensions. So one is just actually three dimensions. One is on the supply side. If the Chinese economy reopens, we will have fewer of the lockdowns and supply chain disruptions that we've had in 2022, even though the Chinese economy had learned to adapt better to these localized lockdowns, and they were not having as much of an impact in 2022, but they were still disruptive, and we should have less of that. So that's an increase in supply, if you want. That's one channel. Second channel, of course, resumption of consumption by Chinese households, who are now able to go and can spend. And we see that, for instance, one important dimension with a spillover aspect to it is tourism. We see a significant pickup in tourism coming from Chinese nationals who want to travel again. And the third is that a Chinese reopening is also going to put some pressure on demand for primary commodities and energy. So there is potentially a little bit of a lift in energy and commodity prices coming from that. And people have been looking at that carefully. Could it be that we would get again a surge in energy and commodity prices? Could it be something that complicates the fight against inflation in the rest of the world, because it is an integrated market? That doesn't seem to be the case right now, but of course that needs to be monitored. So these are the sort of the three channels you can think of, demand, supply, demand, and commodities. From previous work we've done at the fund, we have sort of a rough number, which is every time Chinese growth is 1 percentage point higher, it creates an additional 0.3 percentage point growth in the rest of the world. So we find that there are significant spillovers of Chinese growth to the global economy. And of course, that is not distributed uniformly. The close trading partners are likely to benefit more than distant trading partners. So this is sort of very near term. You mentioned the property sector. So obviously there is, that is a concerning situation. I mean, we know that this is a sector that's used to represent a pretty significant part of economic activity in China. Actually, that was something that was almost by design. The policies were designed to try to boost construction and try to boost the property sector, and that fueled domestic growth in China for a number of years. But it got to the point where that sector got ahead of itself. And there is some consolidation, there is some support that needs to be provided, and it's certainly not going to provide the same contribution to domestic growth going forward. That is likely anything that has to do with credit, property, et cetera, can be very slow in being resolved. And it can be something where the incentives are such that you want to keep things on the book, you don't want to recognize the losses, so that creates a debt overhang, then you're not generating much activity. And so we have a number of historical episodes where if it festers, it can be a drag on growth for a long time. So we're certainly encouraging the Chinese authorities to address, for instance, the issue of pre-sales and making sure that the developers can deliver on that, and then looking carefully at the financial conditions for developers. That's something that is weighing down on Chinese growth. There is then the medium to long term. And here, and without getting into the geo-economic fragmentation, there is something that we can say that sort of skirts a little bit the issue, which is the Chinese economic model up until recently has been fueled, very successfully so, by an export-based model. And it's been difficult, although the Chinese authorities have wanted to do that for a long time, to pivot to a domestic engine of growth. And the property sector was an attempt to do this, but it sort of is petering out in a sense. It's not delivering sustained growth. And so the question here is, what is the growth model that China is going to have in the next 10, 15, 20 years? And if in the next 15, 20 years, and I'm providing an opening for your geo-economic fragmentation question, if it's not going to be built on engaging in the global economy and still being an export-driven part of the trade matrix, then can it be done by relying on domestic engines of growth? And there are significant question marks on this. Existing estimates of productivity growth in China are not particularly encouraging. It's a growth model that's also has a very strong capital deepening component, public investment, property, and so one has to be concerned about the ability to sustain high levels of productivity growth going forward. This is actually one of the reasons in our forecast we have China's growth moderating in 2024, well below the Chinese objective of 5.5. We are projecting 4.5, and some of the reason is we are concerned about the longer, growth engines for the Chinese economy.
Yeah, thank you for that, Olivier. And I do want to pick up from the opening that you've provided us to talk about some of the longer term growth challenges, not just in China, but everywhere in the world. You and I both spent quite a bit of time cutting our teeth, as it were, at MIT, learning from the great growth theorists from an earlier era. And the story then, of course, is that it's technology that drives growth. I mean, all the rest of the stuff, the demand side, that comes along, but in the long run, it's technology. And right now, China and the United States, or China and the West, many other countries associated with the kind of use of modern technology we've run into our own set of headwinds, uh, coming loosely under the label techno-nationalism, where technological development in information and communications technology, quantum computing, artificial intelligence, a range of similar things, are now brought under considerations of national security. And this national security has become quite an obstacle to the way in which the world can co-innovate, as your report describes. So I guess looking forwards, unless we are able to resolve these national security considerations from geopolitics seeping into geo-economic fragmentation, the room for maneuver is not great. Your report and a lot of the conversation from IMF, I think very appropriately describes how multilateralism is the way forward. We need to build institutional international structures, among them G20 and others, that will unify the world's advances in this. But arrayed against that is a kind of zero-sum mentality that's emerging in some of these geopolitical rivalry discussions. And I wonder if at IMF or you yourself, how much can we continue to push the multilateralism angle, which now becomes so important for so many of these international issues?
Well, this is a sort of a core question, I think, for us and for the global economy. You're absolutely right. The technological decoupling, which is actually one of the things we looked at in some of the work I presented earlier. This can have huge effects. I mean, in a sense, there's sort of like a U curve of the cost of fragmentation. In the short run, things can be very costly because you cannot substitute very easily in the short run. In the long run, things can be very costly because you can be on different technological trajectories, and that those things are accumulating over time, and so we could very well have this type of distribution. And in our simulation, it's very clear also, that's another thing that we find, that the countries that are further from the technological frontier, not surprisingly, are going to suffer more. And in many ways, even though China has put a lot of effort in catching up to that technology frontier, our estimates suggest that it could still be suffering quite a bit from this type of decoupling. So you're absolutely right on this, and we see this as a great potential cost to the global economy. What can be done? Where we are sitting at the International Monetary Fund, and not just the International Monetary Fund, a lot of this has to do with trade. So this is an issue for the WTO. This is an issue for a number of multilateral institutions. There are basically two ways of thinking about this. So not necessarily orthogonal, one from another, but one would be to say, look, we really have to be pushing on all those fronts, and we cannot cede ground on any of them. And we have to be sort of screaming and fighting to really make sure that we can remain where we are and make progress on trade issues, for instance, along with other issues. And given the winds that are blowing right now, it's extremely difficult to do that. And if you think about, for instance, the WTO right now is in a situation where, because it doesn't have a staffed appellate court to have a dispute resolution, it's very difficult to make progress on any trade issue. So we could be doing this, but we could maybe not achieve at the end of the day much progress. And we could also be in a situation where, there are only so many things that we can try to push on. So the alternative is to try to have a pragmatic approach to multilateralism. And that's something that we outline in this staff discussion note that we published a couple of weeks ago, which is to say, look, there are a number of issues where right now it's almost impossible to make progress. Issues of technological sanctions are one of them. For instance, the kind of sanctions that, on advanced semiconductors or things like that. But there are issues where we can still be around the table and we can still try to make progress, whether it's climate, or whether it's debt resolution, finding agreements between different creditors, Paris Club, non-Paris Club creditors, to help low-income countries, or issues having to do with pandemic preparedness. So let's try to keep and maybe reinforce the fora where we are able to still make progress. And by doing so, maybe along the way, rebuild the trust, rebuild the bridges that will eventually allow us to re-engage on issues where we cannot have these conversations right now, whether it's on trade or other issues. And from that perspective, I think the fund, the IMF, is in a very interesting position. Because if you look at what all the tensions that have been happening in the last year, despite, I want to say, despite everything, and despite, with very firm condemnation by the fund of Russian invasion of Ukraine and all of this, and we have been able to work. We have been able to make progress on a number of key issues. We've been able to provide relief, emergency programs for countries that were hit by the food crisis. We had what is called the food shock window, develop a new instrument, the Resiliency and Sustainability Trust, that is trying to address longer-term challenges related to climate or health preparedness that low-income countries are facing. We've been able to make progress on all these things, despite the fact that we have a board that represents 190 countries in the world. So that, in a sense, is a sign of optimism. We were able to do this, and in a sense, having this kind of fora is a way with which we can, and maybe this is the optimist in me who is speaking, but trying to make progress one step at a time.
Yeah. Thank you for that. That is indeed a very hopeful vision, and more power to you and the organization for continuing to sort of fight the good fight in developing these multilateral arrangements. I want to turn to the audience. I have some questions online, but I want to give priority to the people here in the first instance. So maybe Bert, I can get you to start.
Hi, I'm Bert Hoffman. I work for Danny, but I also had an East Asian Institute. It's focused on China. Thanks very much for your very good presentation. I was looking at these costs coming from these models on geopolitical tension. Now, if I were a congressman in the United States, I'd say 1.5% of world GDP by 2030, I'll take that. Same with Xi Jinping. I'd say, well, the costs are not that big. And if I isolate myself from harassing sanctions from the United States for, say, 3% of GDP, the Asia number that you gave, by 2030, that's all right. So what are we missing in those models? What is not in those models that we can still explore? So, because I'm a baby of the Cold War, and it actually looked very different in the Cold War than what these projections show. Thanks.
Thanks, Bert.
Okay, well, I mean, it's a very fair question. So at one level, one could argue, look, every one of these models is looking at one particular channel. One could imagine that some of these channels, whether you have trade, trade fragmentation, technological decoupling, you have, for instance, a rerouting of energy supply along different routes that sort of increase costs of energy in different regions of the world, financial fragmentation, that these might be additive in ways, or maybe the addition of the different parts may lead you to much bigger estimates of the cost. So I would say that each of them is highlighting one particular channel. I want to say that these channels are not that. I mean, these costs are not that small. I mean, if we think about 3% of global GDP, this is something that is, or even 1.5% of global GDP. This is something that is quite significant. Again, if you want to put it in perspective, compare it to the cost of having a recession of the typical size, and you might be having something that is at least and doesn't sort of bounce back. So you're looking at a sort of a permanent effect there. So I think these to me don't sound particularly small. So that would be my sense. Now, there's a deeper question here, which was, what are we missing? And I am not going to claim that somehow our models are encompassing all of the different channels. One of the things that our models are not maybe very good at capturing, and which we've seen in a sense, if I flip your argument around, is when thinking about the gains from trade integration, for instance. Okay, we go around and we say the benefits of integration are huge. Well, this is just the same model flipping the signs, and it's the plus 1.5, plus 2%. And we think that these are sort of accumulated over time, and especially if you think about the dynamic and technological channels, can add up to something quite significant. But they're also missing the distributional part. And, so I want here take a minute to think about the political economy. You might say that 1.5 is not such a big deal. That's an average number. The distributional effects could be enormous for some categories of workers that would be totally wiped out because somehow now they are completely cut out from the global supply chain. They lose the particular segment of the supply chain that they're working on is wiped out. And so you have you have like a China shock in reverse. And that would hit different people, of course, than the ones hit by the China shock, but it nonetheless would be very significant for them. And we leave, in a sense, with the political economy consequences of forgetting a little bit about the distributional assumptions of some of the political choices we're making. The rise of populism in many countries is a consequence of a discourse on the benefits of integration that has overlooked some of the distributional dimensions. And so here, there is sort of the sign is always negative. If you integrate, you have distributional costs. If you disintegrate, you have distributional costs as well. And so that's how I would want to approach your question.
Can I just quickly add as well? I know we're running out of time, Olivier, but the distributional costs that kick in can be along the lines of a distribution of income and outcomes across the population. But it can also be the distribution of the uncertainty and risk surrounding your forecast. So there are extreme events that, so for instance, decoupling does not very readily take into account how the how it sort of coincides with the urgencies of the green transition. China today produces, as you know, over half the world's wind turbines, 70% of the world's solar panels, 95% of the world's lithium-ion storage for electrical vehicles. And a decoupling from that kind of a manufacturing capacity might have, in expectation, an average value that's small, but on the other hand, could have hugely dramatic consequences on the plans that we have for climate. And that kind of distributional things are not as easily captured. So if I were a US congressman, I would be very worried. But then, I would have to be thinking about distributions rather than just a single fixed number. Okay, perhaps I take yourself and then I'm going to go to the please.
Morning, Daniel Moss, columnist at Bloomberg Opinion. You talked about a prospective turning point, though you were careful to add some caveats around that. What makes turning points generally so difficult to call with confidence in real time? And if we are in one now, is there something about this one that's particularly fraught? For example, it's not associated with deep trauma like the pandemic or like the GFC. But if you could elaborate a little bit on how you wrestle with that. Thanks.
I would use a nautical analogy. When the wind is blowing at a sort of a steady speed, it's easy to predict where the wind is going to be blowing from in the next hour or so. When the wind is sort of calming down and dying, it becomes hard to predict where the wind is going to blow from when it starts again. And that's kind of the turning point analogy, is that, we have a number of drivers of the global economy that have been very important in 2022. Now, and they were all sort of pushing in the same direction. We were saying earlier that, the three main engines of growth were stalled, but China was stuck with the zero COVID policy that was preventing a strong growth. The US was dealing with the tightening of monetary policy. Europe was dealing with tightening of monetary policy and inflation, plus the energy crisis. So you put all of these things together, everything was going the same direction. In that sense, there was, things could get worse. This is why we're emphasizing the downside risk, but there was very little hope that somehow things would somehow turn out very, very bright, very, very quickly. Now we're seeing things sort of going in different directions. So reopening of China, the growth in Asia, the inflation sort of showing signs that it's abating. So we are getting nearer to a point where the forces could realign in a different way, just like the wind is dying and it's all blowing from a different direction. That's what makes it difficult as a forecaster, or as trying to sort of figure out whether we're going to get more of the same or if things are going to be really coming differently. Now, in terms of the underlying risks that we're facing, I've outlined the ones we think are particularly relevant. Uncertainty about China, inflation dynamics, it's still very, very early to be quite confident that somehow more tightening is not going to be needed, or that somehow wage growth is not going to pick up in a way that may derail some of the disinflation process. Some wage growth is certainly going to happen, and it's legitimate. There's sort of a catch-up dimension to that, but the question is how much and whether that leads to second round. So I think these are sort of some of the big risks. And on the energy front, I mean, we're still in a hot war environment in Europe, and a lot of things can go wrong in an environment like that, and that goes beyond economics here. And so I think we have to recognize this.
Yeah, excellent. Thanks very much. I have a question I want to take online, but I'm just going to ask the question first, and then say that I think you've kind of answered it already, but so maybe we expand it a little bit. So the question is, do you have a political scenario that actually gets us to policies needed for climate change? And you kind of answered that question in the sense that you talked about how, you've tried to get people together to undertake a concerted, collaborative action. I suspect that this question might be more focused on political change in the United States. So you have your home there, you're seeing the political developments around there. In a sense, the United States is the 800-pound gorilla, and that we need to shift elastically for the global cooperative policy. So do you have a sense of the kind of political scenarios that might emerge in the United States that would make it easier?
Well, in a sense, I would say that we have a very positive development. We've had a very positive development in the US, because it is true that US climate policy was, at least at the federal level, there were things happening at the state level, but at least at the federal level, which is a level at which some of it needs to happen to really have the kind of leverage and staying power. Not much was happening. And we've had legislation in the past year, the Inflation Reduction Act, poorly named because it's much more about climate than it's about inflation, as really a lot of elements that are about dealing with climate transition. Now, it's done in a way that is generating a lot of anxiety among trading partners, especially in Europe, but in other parts of the world. But it has and it's working. It's not working with carbon pricing, for instance. It's putting all the emphasis on subsidies as the way to get there, and that reflects the political reality in the United States. But at least there is momentum in terms of addressing climate transition and reducing carbon emissions. So I think we have to find ways to build on that. We have to find ways. In a sense, you could think that we are in a third, fourth best world, in which some of these policies obviously have distortionary trade consequences that, of course, we have to work to minimize, but they're also improving on the climate. So we're dealing with, coming closer to addressing one externality, which is the climate, but maybe trying to minimize the distortions on another front, which is trade. And navigating that is sort of where I see the discussion taking place right now. But I would say that there has been momentum, and we should recognize that and build on that going forward.
Thank you very much. Again, an optimistic note that you've been able to bring to us. I know that we're out of time, and you and your team probably have to be rushing somewhere else, but would you be willing to take one last question from, okay. So there was someone in back. Yeah, sir.
Thank you very much. My name is Raymond Wu. I work in finance. I have two short questions. I'll make it really short. Firstly, so some scholars have said that they are not calling for an abrogation of multilateralism and global trade, but rather the reimagining of multilateralism, i.e., minilateralism. So, for example, why rely on China, which doesn't share common values, and why not develop Vietnam and India as the next China's, which do share certain common values? So what's your take on that? First question. Second question is, this conversation on geo-economic fragmentation and decoupling has been greatly centered on the West and China. But how about the countries in China's immediate region, Southeast Asia, Japan, Korea, India especially, as well? So I work on the Japan market. Where do you, what do you see Japan's role, and how do you think it could and it should be handling this as part of maybe the broader China +1 strategy? Thank you.
Thank you very much, Mr. Wu. Over to you, Pierre.
I will have a quick answer. I mean, it goes, I'm not sure I'm going to say something very, very deep, but I mean, I think, so first, I would start in reverse on Japan. Japan has certainly been a very strong partner in terms of efforts to broaden multilateral efforts to address a whole range of issues, whether we're thinking about climate, whether we're thinking about debt issues, whether we're thinking about support for low-income countries. So Japan has been a fantastic partner in many dimensions and for many, many, many years. Now, the reality on the ground is China is one of the major economies in the world. And so, we as a multilateral institution, we work with all the countries that are here, and China is very important. And as I try to indicate, we can find ways in which we can work and find areas of agreement on some particular items and make progress that are for the greater good, if you want, even if we don't agree on everything that is being done. And I think having sort of an absolute position that we are not going to engage on anything unless you share our values, whatever those values are, is something that would be deeply problematic in a world that is very diverse and where values are very, very different. And we have to recognize some of that diversity and work with it and embrace it. And through the common, and again, this is my optimistic hat coming back again, but by walking the path together, then values can hopefully converge as well. And I think that's a constructive engagement that we're proposing here.
On the second question, do you want to pick up on that? Geo-economic fragmentation, not just thinking about the US and China, but on all other nations. Now, of course, your work and your team's work actually does look at all the economies in the world. But the question was, do you have thoughts on Japan, Korea, Southeast Asia?
Well, here, I want to say, I mean, all of these are very valuable partners here in terms of the dialogues we're having. Let me broaden it a little beyond the IMF. And I think, for instance, in the current environment, that's a remark I was making earlier. I think one could have two different views about a body like the G20. You could look at the G20 and you could say the G20 is going to be completely paralyzed by the kind of geopolitical tensions, the difference in values. And we've seen some of that in the past year. But at the same time, what we've seen also is leadership coming from large emerging markets, whether it's Indonesia or India now, that allows these countries to be, they're in a position to bridge also a lot of the differences and make progress. And so again, there are signs of hope there in having countries that are not the big powers, they are not the US and China, but these countries that are sort of in the middle and are also being very impacted by what might be happening in terms of geopolitical fragmentation, having their voice and having a say in the global discussions that we're having. And I think that's very important.
Thank you. I think I'm going to have to call this to a close. I'm going to thank you, Pierre-Olivier, for such a compelling presentation, for such a compelling discussion of the challenges that we face, and for your good humor in dealing with our questions. You and your team have done the institution proud, and we very much hope that you will come back to this part of the world and engage in these kinds of conversations even more. Kind of a, how people have after COVID gone revenge shopping. What we want is revenge IMF back here. More and more.
That would be a pleasure.
Also, I want to thank everyone. Thank everyone for your attention and your time. It's been a wonderful, wonderful visit. Thank you so much.
Thank you.